Are you guys not freaking out about this stuff? Because I'm freaking out. I can't believe how much debt they're building up, and they're obviously just going to go until it can't go any further, and they'll just let the system blow up. By all intents and purposes, any way you look at it right now, the stock market is heavily overvalued. I'd have thought that what might be best for you is if I did a whole overview of my economic thoughts, where I think things are going and why. We'll talk about every aspect of the economy, unemployment, real estate, cryptocurrencies, everything. And at the end of the video, just for our subscribers to the Peter Leeds newsletter, I got a special message for you, but we'll put that to the end. Plus, I want to tell you something about my UP.THINKING book. So let's get into it. I'll show you a visual look at all of my outlook for a lot of economic trends and tides that we're going to be dealing with in the near term. And if you want us to keep an eye on all of this stuff for you, please subscribe to the channel. It really helps us a lot, encourages myself and my team. Look at the last 3 reads for the GDP for the United States. I've been telling you that we're coming closer and closer to a recession. This is what I talked about a bit in the last video. Quarter 3 last year, 4.9% growth. Quarter 4, 3.4%. And then quarter 1 of this year, just released recently, was a surprising miss at only 1.6% growth. So 4.9 to 3.4 to 1.6, if it fell that much again, we would be in recessionary territory right now. And you can see that the trend of the GDP getting lower and lower, it's actually pretty steep. And I always tell you guys, you know this, that it's about the speed or the slope of the trend. We're falling quickly. Hopefully we'll turn things around and get back on track. But a lot of the growth we have seen, even though it's still coming down so aggressively, has to do with a lot of government employees and military spending, all of which adds to GDP. Overall, the federal government is the largest employer in the United States. As of September 2023, approximately 2.95 million individuals were part of the U.S. federal workforce. That's millions of jobs that I bet could just be eliminated, but hey, that's just me. But here's a chart from Trading Economics of GDP. And you can see that there was a technical recession right there, and then another technical recession there. No, unemployment I expect to increase quite a lot. A lot of the layoffs that you've been hearing so much about lately are going to eventually absorb into the numbers, and then when they get reported, that's when you're going to notice, wow, unemployment is rising. It was just like when gold prices went higher, but the gold mining stocks hadn't moved. You wait till it absorbs through and they release their quarterly financials, which they do every 3 months, but sometimes it'll be 4.5 months later that they release the results based on the price of gold now, and now they're making so much more money. The same thing with unemployment. There's going to be a lot of firings, and then it does not actually show up in the numbers for months and months. And with stocks, you guys know that I've said many times that I do not trust this market at all. And I told you that, yes, they can make stocks go to the moon through monetary creation, a lot of tricks that they play, just like they can make your house value increase. But they're doing it through debasing of the currency. You'll have a house, it'll double in price, but you're not wealthier. You just have a house that's worth more dollars, but it's not actually worth more. It's worth the exact same. But you feel like, well, I've done so good on my house, it's doubled in price. Of course, some real estate can increase in value because of the developing area or whatever reason. But overall, on balance, house prices will be equivalent to the debasement of the currency, because there's always going to be a whole bunch of houses, a whole bunch of people that want to live in them. But what I wrote in my script about the stock market right now is overcorrection after normalization. You've heard about reverting to mean. Investments are always trying to revert to the mean, where they're typically trading at. If they're above that, they're most likely being pulled lower. And if they're below that, they're most likely being pulled higher, always trying to revert to mean. But what I said was an overcorrection beyond normalization. It's trying to normalize. It's going to go beyond that. It's going to be reverting beyond mean. I tell you that it's like a pendulum. When stocks go one way, they go too far that way. Then they come back the other way and they go too far that way. But we're always in a status of moving towards healthier levels. And the levels right now are not healthy. They're overvalued so much. That's why I did that video recently about talking about the articles about the bizarrely overvalued stock market. That's why I showed you the CAPE ratio. That's why we talked about the Q ratio. That's why we talked about historical PE levels. By all intents and purposes, any way you look at it right now, the stock market is heavily overvalued. And every analysis metric implies significant, unsustainable overvaluation. And as you're seeing with cryptos, they are behaving more like a risk-on asset So when things like Google and Tesla are dropping in price, often so too are cryptocurrencies. They're not trading in the ways that something like gold is trading. And as they will behave like a risk asset, then they're vulnerable to things such as if there was a stock market drawdown. Sometimes that can engender or cause margin calls where you're forced to sell shares of the stocks that you own. And sometimes people need money in that case, and in which case they might sell other assets they have, which may include cryptocurrencies. I always tell you that Bitcoin is not going away anywhere in our lifetimes. It'll be around forever. And will it go higher in price? Maybe. Will it go lower in price? Maybe. I don't know. I'm not making any statement about it, except that if the overall economy gets weaker, such as in a recession, or the overall stock market gets weaker, those are both risk points that you have to be considerate of. And you know that I've got a very negative look on real estate, and it is only just now beginning to start turning the corner and falling a little bit lower. But it's got a long way to go lower. We're not even halfway through inning one of what's going to happen to real estate, in my opinion. And I should say that these are educated opinions. I know what I'm talking about. I've done pretty well with a lot of my theses and my premises, and this is just some more of what I'm thinking is going to be happening. You guys know I've been around for multiple decades. We're well into our third decade running this company doing exactly this, taking all factors into account, such as macroeconomic events. The pressure is pushing shares of stocks higher, what's pulling them lower. We talk about all that. It's educated opinions, and I've been doing this now for nearly 30 years, doing exactly this. In oil, my position has not changed since I recently put out that oil spike and fade video. So if you haven't seen it, please check it out, because that's exactly how oil is going to trade, and that's exactly how oil has been trading since I released that video. There's pressures pulling oil lower, mainly the slowing of the global economy. A lot of major nations, top-level nations, are in recession right now. Japan, United Kingdom, soon to be America. None of that's going to be bullish for oil. But at the same time, there are so many monumental macroeconomic events going on right now with global conflicts, military conflicts, that I believe there will always be these spikes in oil prices, significant spikes, and then it will slowly drift lower. Spike, drift. Spike, drift. That's what I'm expecting. And with interest rates, there's so much confusion. I've even changed my mind a few times. I was expecting that there'd be an interest rate decrease through the late summer. And the reason I believe that is because it'll make it a lot easier for the federal government to pay their debts that they owe. Not that they seem to care at all about debt. Apparently, I was mistaken to think that anyone ever has to pay back debt. Are you guys not freaking out about this stuff? Because I'm freaking out. I can't believe how much debt they're building up, and they're obviously just going to go until it can't go any further, and they'll just let the system blow up. They'll reinvent the system. We'll go to digital currency. All of this is going to happen. We're going to have a big reset, I know, because that's the only way to get out of this massive overspending, massive debt bomb that we built up that's on all of our shoulders. But this debt bomb is going to become a factor a lot sooner than most people believe, in my opinion. I don't think that we have 10 years, not even close. And if you don't believe me, just look at the trajectory of the trends. Map it out on a piece of paper. You tell me if we could ever afford to pay that debt back. It's a known thing. That's why they have unfunded liabilities. They just divide that out and say, well, we owe that money, but we can't pay it. So let's put it in another thing. We'll call it unfunded liabilities, so it doesn't count against the national debt. In an election year, I don't see them keeping rates high, even if they should. I believe that they will have to at least lower the rates at least a little bit throughout the late summer and into the fall up till the election. But as you guys know, whenever they start lowering rates, as history has screamed at us, when they start lowering rates, that's a lot of the time that the recession gets set off at that point. It's all coming together with the declining GDP, with they're going to be lowering rates. It's all going to happen at once, and we're going to have the recession starting as rates start coming down, which is opposite to what almost everybody believes or thinks, especially retail investors. So when somebody's so offside, or everyone's so offside like that, there is an opportunity there for you to take advantage of. I told you that there was more millionaires made in the Great Depression than any other time in human history except for China. But the way to take advantage of a lot of things that are going on right now, there's always a bull market. There's always great investments, especially the ones we talk about, the low price investments. And I'll tell you about what's going on with the Peter Leeds newsletter in just a second, but I want to say something about my book, Up.THINKING. I've begun a revised edition of it. It's coming along pretty well. And about the Peter Leeds newsletter, I want to tell you guys that you might have noticed that rather than doing just swing trades on the weekend, I'm rolling it into a few other things. So what I'm going to do is I'm going to give you opportunities that I see when the markets are closed, because it makes it a lot easier to do the analysis when nothing's moving around while you're trying to work. And throughout the week, of course, you'll get the hot list pick, plus you're going to get my personal portfolio question and answer, updates on former picks. And if you want us to keep an eye on all of this stuff for you, please subscribe to the channel. It really helps us a lot, encourages myself and my team. If you want some of our free learning tools, or you want to see why the Peter Leeds newsletter is one of the most popular financial newsletters of all time, swing over to peterleeds.com and you can learn all about it.